Way. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Our experts are Ritesh Ashar of KIFS TRADECAPITal, Vinit Bolinchkar of Ventura Securities, and Samir Kalra of Target Investing. Thank you to all of my guests for joining me. Today on Hot Money, we'll discuss Vedanta on the recent crude correction and commodity price rise that has happened. What should you do? Bharat Forge is trading at a 52-week low. What should you do with them? Is there more traction or further weakness that's expected in the housing finance companies? And we talk about the capital goods space, which is there value in the sector? One stock that should be accumulated for a year as far as that sector is concerned. But the first one is Vedanta. Now, what we've seen recently is that commodities have actually started rallying a little bit. Crude is up almost for the 7th straight session, so there is traction. It's come off the lows that we saw recently, but and Vedanta gets affected because of a lot of different commodities as well as crude. So what's the best play for Vedanta? That's something that we ask our guests. So Vinit, you track metals very well. What's the sensitivity analysis of Vedanta to all these commodities? Should you play Vedanta based on rising commodity prices, or is there something else?
So I think a couple of things we have to understand is that two of the businesses which are predominant in the portfolio are oil and zinc. Okay, zinc is a deficit commodity, and people talk of reducing deficit. So the deficits are not going to get worn out. Okay, and the management hunger for growth is very high in Vedanta, and they're growing across segments, outputs for zinc. Oil also, they've extended a PSC for another 10 years, so they're drilling more wells. We'll see more output. They've won 40 other licenses, geographical areas. So these two are going to drive the growth. Price is an uncertainty because price is a factor of market pricing. But I believe that zinc pricing will not fall that much because the smelter profitability of Chinese players is affected by the TCRC margins, which if they turn negative, they don't make any money. So to that extent, I believe that the prices will be sustained. Okay, I'm not talking of a scenario where prices are rising. So given all these things and significant cost efficiencies which are being built into the system across all segments, I think Vedanta is a buy. Okay,
would it be better if you're saying that zinc will be stable, to just buy Hindustan Zinc rather than play zinc via Vedanta, or will the crude play also be an important factor for Vedanta to choose between the two?
So crude is a wild card. So if you want to go for certainty of playing Vedanta, I think Hindustan Zinc is a better way to play the stock.
Okay, that's the way. Samir, you all have been indicating that you all see crude prices rising probably close to the triple-digit number. It has cooled off from that level. Given that, do you believe that if that outlook still holds, will Vedanta be a good play to play crude on that front?
So I think if you keep that outlook, and we still keep that outlook for mid-year 2019, because if you see Vedanta has debt on books. They have a lot of heavy capex plan for next 2 to 3 years, and which will imply that there will be more debt on the books for that capacity expansion, whether it's on the crude or the other minerals. Now over there, when 2-3 years you're putting a heavy capex, then you go into a depression of P&L because the pricing any which way is not in your hands, right? So I think over there it's better to have a combination of maybe a ONGC, Oil India, and a Hindustan Zinc. As Vinit said, zinc is the most appropriate metal in the portfolio. I believe even silver, from my point of view, is a very important element for Hindustan Zinc now, because it's a waste product of the whole process, and they earn good amount of money out of that now, as the volumes are going at 40-45%. So I think Vedanta has an issue of debt. Vedanta has the legal issues. Vedanta somehow comes into that tax issue again and again. And I feel there are a lot of things weighing on it to suppress the stock prices. And even if the commodity prices come back, Vedanta will be I think at the back leg of the things.
Okay, so if you're playing commodities, what's the best option?
So I think if you see, we are optimistic on zinc and crude. So ONGC, Oil India, either of them, and Hindustan Zinc will be the combination.
Okay, Ritesh, what's your view on Vedanta? Are you all bullish? Are you all telling your clients to buy Vedanta?
So I will be very neutral on Vedanta. If you look at overall structure of an organization, the 100% is in the control over a crane and 65% is Hindustan Zinc. If you look at the overall business model, as Vinit has rightly said, it is a combination of zinc as well as oil and gas component. In terms of stock wise, if I look at the stock has almost rise by 20% in last 1 year. No doubt there is a capacity of another 20% to rise from the current price, but at the same time the commodities price which are rising, which is going to affect to the operating margin and the profitability as well. Company is very aggressive in terms of expanding their business in terms of zinc and the oil and gas business all over the globe. So I personally feel right now at the current market price it will be absolutely a neutral view, but long-term structure point of view, if you ask me, the stock can be a buying recommendation if the stock is corrected by another 5 to 10%.
So are you all recommending any metal stocks to your clients at this point of time?
Not really as on today, because overall metal sectors we are not really bullish on it. So we are not recommended anything as of now.
Okay, Vinit, metals, if you want to play metals, basically it's a cyclical thing. So you need to buy some stocks which are at the fag start of the metal cycle, and then you sell it at the peak. Where do you see the metal cycle as such? Is the commodity cycle as such? Is the prime behind us? Are we going to see more pain? I'm just talking overall on the sector.
So there are two parts to this. One is if you take certain metals, like if you take silver and zinc, their reserves are not that much. Their reserves are fast depleting. If you take other metals like steel, if you talk of a global infrastructure which is due for renewing, so that is going to support demand. And we have seen China slowing down. We have seen the US trade barriers put in place. But despite that, for steel, the demand in volume terms is not come down. So I believe that there is still some steam left, and zinc, silver and steel are my place on the upside.
Okay, so that's the view that's coming in on Vedanta at this point of time. Not the best play as of now, at least in the near term. That's the view that we're getting in. Vinit somehow is slightly optimistic. Samir says that better to pay it via ONGC, Oil India and Hindustan Zinc, and not a recommendation on Vedanta coming in from Ritesh. So that's the view on the first stock. The second one is Bharat Forge. Now surprisingly, the counter, which was doing extremely well a couple of quarters ago, now is at a 52-week low, again falling down. Yesterday we discussed how it's down 36% this year. We discussed how the Class 8 truck sales are at the lowest level since August 2017. So that's a small aspect of Bharat Forge's portfolio, but we should not judge Bharat Forge only on that. But somehow has the business model gotten shaken, because the auto business overall is slowing down. So where will growth come in for Bharat Forge? That's something we ask. Samir, is the business model now getting shaken up for Bharat Forge? Are there any avenues where probably you can see growth for Bharat Forge?
So I think what has happened with them is their portfolio has been concentrated on autos. They tried to diversify into railways and then defense. But what has happened over there, these are bulky orders and they come and go. So the book really doesn't go consistently non-auto. So, and especially when you see the exports are dominated by US truck Class 8 orders. So that peaked, and when that peaked, the Bharat Forge orders also peak out. So it's a very constant replication. The other fact which has happened with Bharat Forge is the domestic slowdown on the PV side. And the CV side. So even there the supply is there. So even if now this time domestic gets hit on the slowdown, which I think it will come in next 3 to 6 months. So now there'll be a double impact for Bharat Forge. So I think it's a cyclical business. And in last cycle, up cycle, they have swollen up their trade receivables by around 60% of what they usually used to maintain. So I think this time the down cycle will be much more harsher on them. But I don't think so the business model has all of a sudden, changed, or done something wrong with it. But yeah, it's something which has more
but
downside.
where so if you're saying that there is class 8 on the auto side, there is issue on the defense side, there is issue on the gas side, there's nothing much happening as such. So where is growth going to come from?
So that's what I'm saying. So the down cycle will take it along.
Okay.
And then, as you said, metals have a cyclical. Even class 8 orders, if you see on the cycle, there is a cycle over there as well. So whenever that bottoms out, this will automatically.
So you
bottom out
basically,
with that.
through our conversations, you said that you take these dealer checks and all, you go and speak to dealers. What have they indicated to you when you've taken? Is there an actual? Because what we get right now is at the wholesale level. At the retail level, what exactly is happening? Are they facing severe slowdown among the auto buying space?
So we do a registration check as well. So if you see around 25, 26 states, the registration of passenger cars has been down by 5% YOY on a December to December, because December is the lowest quarter for passenger cars, and that's why the seasonality comes in. So that means more inventory is sitting on the dealers right now, and even at the dealer check it says the same. So now they're looking for incentives, and passenger vehicles and your CVs are the main pain, which is more of the portfolio of Bharat Forge. So I think that pain will last a little 3 months, 4 months onwards.
Okay, Ritesh, are you all recommending Bharat Forge to your clients? Is it a good time to buy at 52-week low?
See, don't consider it's a 52-week low. Whenever, as a fundamental point of view, when we are investing into the stock, we have to see how the stock has rallied and what is the structure of an organization in terms of the product what they are distributing. If you look at the overall stock rally, it has shoot up from 360 to 772 in last 1 year of time, and from over there it has almost corrected by 40% and come down to around 470, 450 odd level. So I personally feel at this level it is considered to be a buying recommendation, or rather it is considered to be a fair value of the stock. Considering the fundamentals of the company, it is amongst the India largest forging, manufacturing and the production and designing of the company. At the same time, they have a presence all over the world like US, France, Germany and Sweden also. If you look at the commercial vehicle export, it is almost grown by reported 28% growth. In terms of net profit, it is almost grown by 11%. And if you look at the revenue growth, it is almost by 28%. At the same time, if I look at the order book value from last 2 years, it is almost 1,600 crores. So in terms of structure, on a fundamental point of view, I feel it is good enough.
Okay.
At the same time, if I compare with an industry PE, it is running at around 34%, wherein the company PE is running at around 28%. So in all the aspect, I feel it is a fair value buying pick at this point in time.
But where is growth going to come for Bharat Forge?
See, as I said, the company is diverting into the automotive and non-automobile segment, wherein automobile segment, it is already getting a growth of 23% on year basis, and at the same time they have to move to the non-automobiles segment as well, wherein it covers the square foot and other activities. So I personally feel in terms of structure wise, there will be a year basis growth and the margin will be intact by 15 to 16%.
Okay, that's the view that's coming in. What about you, Vineet? Bharat Forge, what's your view?
It's a wait and watch story. Okay, price is corrected. And typically, in the peak cycles, they traded about 25 times. From there, we've seen correction. The bottom trough range is it's also still very wide. It's 13 to 18 times. So if you see on FY20 earnings, which is about 25, 26 rupees, we are around there, 460, the upper end of the range. But the larger picture is that, with the CV segment slowing down and CV being inherently linked to, global macro, and with the Fed tapering, quantitative tightening, ECB about to join, and even China will come in. I think there is going to be a kind of a crush on their export business. They have got good levers of growth. So they are aerospace, you have defense, and non-CV based business. But it will take a while to play out, and their earnings also could be at risk.
Okay, so you would wait for a further correction before accumulating the stock. Are the fundamentals intact? That's what I'm asking. Or because see, fundamentals are also the company, but if the external environment is deteriorating, like something that happened with Motherson Sumi, there's nothing you as a company can do.
So what you're looking at, a 8% growth in earnings. Okay, for 8% growth in earnings for FY20 with so a significant amount of risk, I don't want to play that stock.
Okay, so that's the view that's coming in on Bharat Forge. Contradictory views coming in. Ritesh believe it's fair value and should be accumulated at this level. The other two guys believe it's a wait and watch approach for Bharat Forge. So fair enough. That's the view that's coming in. The next one is interesting. Now we'll go into the earnings season, and housing finance is something that we need to closely watch out for, because all the issues that happened earlier, and probably most of the issues or write out will probably come in this quarter. So housing finance company results are something that you clearly need to watch out for. But is there more weakness in stock? A couple of counters have already corrected 30, 40, 50% from the peak. So as a portfolio bet, would you buy any housing finance company? Nothing's happened to HDFC as such. This is the second rung of housing finance companies which has corrected significantly. So Ritesh, are you all pushing NBFC housing finance companies to your clients?
See, first of all, we need to understand overall NBFC has a segment. That NBFC will be further bifurcated into the housing finance and consumer finance and other commercial finance as well. If we'll particularly talk about NBFC, in the recent past, whatever the incidents has happened, the cost of borrowing has increased. And because of that reason, the company has increasing their lending cost. So because of that reason, they have cut short their target for FY19 in terms of disbursement. Many of the companies already not disbursing in terms of liquidity crunches and a lot of other aspect as well. So if you look at overall fundamental point of view for next 1 year, I think we should avoid the affordable housing segment. Instead of that, we should switch to the consumer finance, which is more in terms of micro and macro level of funding needs to be raised. But NBFC hasn't per se, considering 200 to 300 BPS correction and reducing the targets, I'm not really bullish in terms of affordable housing segment.
No, the entire housing finance space also you're not using. You believe that there will be more pain that will come in?
Yes, because the cost of lending has been increased and that interest cost needs to be passed back to the consumer. So on the customer point of view also, if the rate of interest has all of a sudden shoot up by 9.7%, which is not something justifiable business model, this is what I can say.
Okay, and in the NBFC space, apart from housing finance, are you all telling your clients to accumulate anything? So if you said that you are recommending them to switch, so which are these companies?
Bajaj Finance and Bajaj Finsoft is our strong recommendation at this point in time.
Okay, Samir, what about you? Housing finance company, is the pain here to stay?
So I think the pain as a sector is here to stay, because if you see, their main source of funding was commercial papers, and those have either gone very selective on the companies who are able to raise. So only HDFC is the major raiser over there. And if you see the other point, NCDs are being raised, but those are long-term raising, which is at a higher cost. So it's becoming very difficult for smaller players or the new players who have come up in last 3 to 4 years. So we are recommending LIC Housing, Canfin and SGFC on the basis that LIC and Canfin don't have that much exposure to commercial paper and they don't need that much of commercial papers. So over there, the concentration is much more selective, and the funding source is more important now for these NBFCs. This quarter result might not be as disappointing as people expect, but yeah, further on, I think the pain will be even further more rippling.
For other companies like an India Bulls Housing Finance or a Dewan Housing Finance, are those clear avoids for you?
Yeah, because past 4-5 months they haven't even come to the commercial paper market. So that's where we feel that people are not willing to lend them. Somewhere JM Financial or Edelweiss came in and they raised at 150, 170 bips up from last year. So that cost has to be passed on to the customer, and which I think will create some issues for them. Okay,
Vineet, what's your view on housing finance company? Is there more pain?
Yeah, I think there's a lot of considerable pain. One is there's a slowdown. There's a asset liability mismatch. You have higher cost of funds, and we're talking of buffer capitals also. So tier 1s are also under stress. So given all these scenarios, I think the best play is going to be HDFC. Because clearly they can continue to grow. They've exhibited growth across all cycles, and they will dominate with more market share. So if you see, even your Group Finance had a slight ALM mismatch, and they have not absorbed the company in HDFC, but rather gone and merged it with Bandhan. So I think the logic out there is that you have a source of strong parental source of funding, Bandhan being a bank. So all the other players, those who have got strong parentage of a good, stable, long-term source of funding will only do well. And that's clearly the differentiator right now.
So my thing is that even if you look at HD, everyone talks about HDFC, but it's an industry leader here. But even they are affected by the issue because offtake in real estate is clearly not happening at this point of time. People like Lodha, people the other groups have also come out and said that offtake is not happening, and they are saying that everything's well, but somehow that's not the case. So even won't HDFC also be affected because lending won't happen?
So what happens is that HDFC can gain market share, so it can cannibalize. So while the other people are restricted from gaining. So like if there are issues on Devan and Indiabulls housing, we really don't know what are the issues. Okay, and as we speak, the RBI was supposed to meet up with the HFCs, and if we see the body language of the RBI governor, they just tossed the MSME back into the court of the government. So there is still continuance of its prudent policy. They have not given into populist or government measures. So I don't think that anything great is going to come out of today's meeting, and I think that could possibly shift. The little hope that was there would start crashing again. So I believe that in that kind of a scenario, HDFC will clearly gain from its market share expansion.
Okay, you're using similar logic for HDFC because you also spoke about HDFC.
No, what I am saying.
What's your logic?
My logic is simple. See, right now, even if you're talking about the renewals of refinancing, whatever is coming and everything else, or market share gains. Market share gains can be only there when you have the additional funding with you. If we talk about the commercial paper market in last 3 months since the whole thing has unfolded, if you see 60% of the housing finance funding has gone to HDFC. That's CP market. So that means they are sitting with a lot of cash. When the opportunity comes of lending or where it comes, that is a whole separate thing. I'm not saying that they'll not be impacted with the numbers or the whole sector downfall. But the only point is now that downfall will be much more restricted in HDFC than other names because the rolling of the same instrument is happening. Where the rolling of the same instrument doesn't happen, then I'm taking a 3-year loan to fund my repayment of 1 month. And then I have only additional money, which is like for, let's say, a 10%, 15% of it.
Okay, so I think the consensus views happening is be selective as far as the housing finance companies is concerned. Not too much of flavor, but a few names that came up, HDFC being the prime name that our guests are speaking about. And the last one is capital goods. The third quarter was really good for some of the capital good company, like a Siemens or an ABB, and I was going through some of the preview reports that came out, and all of them do indicate that execution is going up. So should you play capital goods? Is there really execution that is happening? And so we're asking a guest as a positional play, not like a short-term play, but more like a positional play. Is there any capital good company that you would accumulate at this level? Vineet, are you all recommending any of the capital good companies to your clients?
So, the capital goods, we spoke to Siemens, we spoke to a lot of these other companies, but their order books are not that encouraging. There is no winds to show that there is a promise, but it has not come in. In fact, this year the Siemens order book is around 5%. So given this kind of situation, I would rather play the capital goods through consumables. And we like the bearings industry. Okay. So we like Schieffler. Now Schieffler has a direct exposure about 52% to the automotive sector. So that is like a headwind. But on the other side, they have 23% which they were importing is now getting localized. So, and in a bad quarter also, their margins have not been gone down despite input cost pressures. So I think this company looks good, and it's 206 rupees EPS for FY18 can become about 270, 280 in the next 2 years. So you're seeing about a 40% jump. So I think there is growth out here. There is efficiency in operation, margin expansion possibility. So I like this stock.
Okay, not direct exposure to capital goods as such.
So it's very difficult to expect a recovery in the capital goods. We are due for a rally, but it's all been piecemeal. It's not like a healthy order book. No one is sitting on a 2-year order book. There are very few plays, but they're expensive. So I would like to see the order book build up being substantial. before getting onto the capital goods bandwagon.
Okay, what about you, Ritesh? Any capital goods stocks that you all are pushing to your clients?
Yes, definitely we would like to bet on L&T.
Okay.
The reason of L&T, if you look at the overall consolidated revenue growth, it is almost growing by 21%.
Okay.
The reason behind is they have improved the project-based business into very execution of the project-based business is fantastic. At the same time, the service business has also improved by 12%. If you look at overall international business is almost grown by 22%, which is equivalent to 10,000 crores. And if you look at the book value of international business, it has almost 8,000 crores. And if I look at profit after tax, which is almost 22%. So in terms of profit after tax is fantastic. Revenue growth overall, it is consolidated growing by 21%. And if I further bifurcate it into the domestic business and the international business is also growing by 33%, which is equivalent to 10,000 crores. And if I look at the order book value, it is almost 8,000 plus crores of international business.
Okay.
If I compare with the market P, it is same running at around 23.5. So in terms of P perspective also, it is reasonably good amount. If I look at price to book value, it is running at almost 3.02x. So I personally feel L&T is going to be a very structured way of investment and a good company to stay.
Okay, so L&T, Schaeffler, and the final one, what about you? Which company?
So I think Kirloskar Oil Engine is one which we like. Over there, what is the story is threefold. One is they supply into diesel pump sets for agriculture, so that production is consistent, and the other is the gensets. So let's say they are lower than the horsepower of Cummins, and they are gaining market share with the non-import place over there. So the main competition is China imports, and over there they are increasing their market shares. The only problem which they have is right now 85% capacity is utilized. So the upper trigger is a little far before the capex kicks in. And the margins are slowly expanding. So this year they showed around 25% of profit growth. They are net cash around 20 crores.
Okay.
Their market cap is around 3,000 crores. And ROCs are around 12 to 13%. They are a stable company, but the valuations have gone to 15 times as compared to Cummins, which is trading at 32.
Just hold on a second. I think Arun Jaitley is speaking. I think we need to cut across that. I think he's speaking on the Supreme Court chart.
In accordance with the recommendations of the CVC, the government had felt that in the larger interest of fair and impartial investigation and the larger credibility of the CBI as an institution, the two officers must recuse themselves, which the CVC had formulated in form of asking them to go on leave. In the Act, that is the Delhi Special Police Establishment Act, which deals with the functioning of the CBI, there are two separate provisions. One provision, of course, is very clear that matters relating to the appointment, removal or transfer of the CBI director can only be done by a special committee comprising of the Honorable Prime Minister, the Chief Justice of India and the Leader of Opposition. And there is another provision that in cases of corruption, the power of superintendence over CBI is to be exercised by the CVC. The CVC had exercised its power in making that recommendation under that power of superintendence. We have not read the judgment of the Supreme Court, but presumably it could have been a possible view which the court has taken, that if superintendence results in the chief relinquishing his powers even temporarily, then the jurisdiction of the committee, which is the appointment or removal committee, comes into the play. It's a possible view that the court has taken, and therefore the court has referred the matter to that committee to decide on this issue within 1 week. The government has been directed to convene a meeting of that committee as per the reports which are so far available. The court apparently has strengthened the immunity given to the CBI director in the larger interest of a fair and impartial functioning of the CBI. At the same time, the court has devised an accountability mechanism. This is in accordance with the norms of fair play. And therefore, in accordance with the directions of the court, obviously they will be complied with, and the government would act in the same manner. आज सुप्रीम कोर्ट का निर्णय सीबीआई डायरेक्टर ने जो याचिका डाली थी उसके ऊपर आया है. सरकार ने सीबीआई उसकी विश्वसनीयता.
Okay, that was the finance minister speaking, but with that we are timed out on this edition of Hot Money. Vineet, Samir, Ritesh, thank you so much for coming into the studio for the show. Ask BQ comes up next. Stay tuned to Bloomberg Quint.